What's up, you guys? Boris here with today's finance talk. And before we jump into content, I first want to take a moment and praise everybody who's been subscribing to my YouTube channel and showing me support. I appreciate all the support. I appreciate all the comments and the feedback, all the subscriptions and the likes. You guys are truly valued, and I will do everything in my power to support your investment endeavors. So let's jump into content, you guys. Today's finance talk is about investing. We're going to be comparing and contrasting real estate investing, particularly rental investing, to that of the stock market. What is a superior investment? And let me first state right now, I know what you're thinking. I know you're thinking that Tesla has returned a 500% year-to-date return on your investment. And if you made those type of returns, then I congratulate you. That is phenomenal. That has far outpaced the average return on your investment. However, I need you now to take a step back and reevaluate going into 2021. Can you anticipate another 500% per year return on your investment? In fact, the S&P has averaged an annualized return over the past 90 years of an average of 9.8% per year. That's not too shabby. We're talking an average of 10% per year. But I'll tell you now, real estate investment, rental investing, will far outpace 10% per year. And not by a small margin, by a great large margin. So we're going to compare and contrast why real estate investing is superior investing. It's a superior investment to that of the market. And then finally we'll do a case study. I'll tell you guys now, stay tuned to the end because I'm going to be revealing a golden nugget. What is the number one reason as to why real estate investing is a far superior investment to that of stock market. Alright guys, let's jump into content. We're going to be doing a comparison to investing in the stock market as opposed to investing in rentals. And then finally we'll do a case study. So number one, the positive for the stock market is there's a low barrier to entry as opposed to rental investing, which is highly capital intensive. You need to save up a lot of money to purchase your first investment property, as opposed to the stock market where you just need a few dollars to really purchase a stock. And you could fund your brokerage and purchase a stock with just a few dollars, honestly. Number two, stock investing is very passive. It's not really time intensive as opposed to rental investing, which is very much taxing on your time. You could try to institute a property management company to try to systematize processes. However, for the most part, it's very time intensive. You need to find tenants. You need to write leases. You then need to repair and do property maintenance. So it's really very much time intensive. The next comparison is dividends. Both stock investing and rental investing, they both pay a form of dividends. So in terms of stock investing, there are many companies that are what we call a high-yielding dividend payers, meaning they pay in excess of 4%, in excess of 4% of their stock value. Excuse me, they're basically returning some of their earnings to their stock investors. And here's a list of what we call high-yielding dividends, stock-paying dividends. Anything in excess of 4% is considered to be a high-yielding company. So as you can tell, there's a lot of options. However, even with the good high-yielding dividends-paying stock, rental investing still outperforms high-yielding stocks, and we'll get further into that. And in terms of rental investing, there is a form of dividend that you could achieve in rental investing. That's called positive cash flow. After you pay your mortgage, taxes, insurance, property maintenance, and so forth, your positive cash flow is a form of dividend you put directly into your pocket. Next is appreciation. Both stocks and real estate can fluctuate in price, and both can enjoy price appreciation. So they both have that going for them. Next, we're talking about market value. Whenever you purchase a stock, you're buying it at the market value because there's buyers and sellers on both ends of the transaction that are negotiating to come to a price. That's known as a market value. But the stock market is one of the most efficient marketplaces in the world. Reason is because there's so many buyers and sellers on both sides of the transaction that it becomes very efficient, as opposed to buying real estate. Real estate, there's only a few buyers and there's opportunities to find equity in a deal. You could basically buy a piece of real estate below market value and basically as a result have instantaneous equity when you buy the property. That's not possible in stock market when you're buying stocks at market value. That's one of the most powerful things in terms of real estate investing, is the ability to have instantaneous equity. In terms of tax advantages, real estate investing is far superior in terms of tax savings tax strategy as opposed to the stock market. The stock market, you could experience long-term capital gains if you hold a stock for at least 12 months. And when you're taxed on those gains, it's at a lower rate than regular income tax, which is a great incentive. However, with real estate investing, there's far more tax strategy. In fact, the tax code favors real estate investing above any other investment strategy. They really incentivize Americans to invest in real estate, from depreciation to capital expenditure. There's really a lot of tax strategy involved in real estate investing. And in fact, as a real estate investor, you could be making an income every year. However, you could be showing a loss on the books. So that's amazing. And in terms of leverage, you can leverage in both real estate investing and the stock market. However, with the stock market, it's highly risky and very rarely is it done with margin. The reason being is because your brokerage should do what they call a margin call and force you to liquidate your position at any moment. Say, listen, the money we borrowed to you, we want it back ASAP. And even if you have a loss in that position, you're then forced to sell it and lock in a loss because the brokerage says they want their money back. And leveraging with the real estate is a far superior strategy. We basically use mortgages and we're able to leverage our investment. So that's one of the greatest investment strategies. I'm going to jump into that right now. Alright, you guys, I prepared this presentation in which we're going to do a case study. We're comparing, contrasting an investment where we're putting in the same $70,000 investment in the stock market as opposed to putting it into a rental investment. So let's start first with the stock market. Let's say we put it into index fund S&P 500. Like we previously stated, we're averaging an annualized return of approximately 10% per year. On $70,000, that's $68.60 per year. Not too shabby. Plus, we're compounding that. Now, let's compare it to rental investment. Let's say we bought a rental property, a two-family, for instance. We bought it at $300,000. We're putting a 20% down payment plus $10,000 in closing costs. That's the same $70,000. But I know what you guys are saying. Let me take a step back. I know what you guys are saying. You're saying we just lost $10,000. We just tossed it aside and $10,000 in transactional funding. Those are our closing costs. That $10,000 didn't go into equity in our property. It was just for closing costs. We only put $60,000 as down. The other 10 was tossed aside to pay for attorney's fees and surveys and all sorts of other stuff involved in closing costs. I'll give you that, the naysayers. I'll give the naysayer. You could put that feather in your hat. But even after having lost $10,000 off the bat, real estate investing still will outperform the stock market. And let's get into the numbers and you'll see as to why. So, excuse me, let's say you're collecting $3,000 in monthly gross rents on the property. For instance, this is a two-family home, and each unit is paying us $1,500 in rent. You're collecting $3,000 a month. Your mortgage, taxes, and insurance, you're paying $1,745. We'll calculate $100 for maintenance and utilities per month. We'll calculate $150 for capital expenditures. This is for big-ticket items like fixing your furnace, redoing your roof, not maintenance, but like really replacing equipment in your home. So you're combined with your mortgage, taxes, insurance, plus your maintenance costs, plus your CapEx cost. We're looking at $2,000 a month. However, we're making $3,000, so our cash flow margin is $1,000 per month. That's the $3,000 in gross rent minus $2,000 a month in costs. So we're making $12,000 a year is our margin. On our initial $70,000 investment, that's a return of 17% per year. Not too bad. We've already outperformed the S&P 500. However, it gets better. It gets far better. What about real estate appreciation? Nationally, we averaged 3.9% in real estate appreciation per year. So on our $300,000 home, we're averaging a real estate appreciation of $11,700 per year. Now, our net worth is increasing by the $11,700 that we made in real estate appreciation plus the $12,000 in cash flow. So we've basically increased our net worth at the rate of $23,700 per year. That's a 34% return on your investment already. How does that compare to the 10% return on your investment in the S&P 500? So let's move along. Let's compare that to a 10-year rate of return, because what we're neglecting to consider is principal pay down. Let me just take a step back here. This ROI of 34% per year, we're still missing one variable. And it's hard to compute it per year because that's what I'm talking about is principal pay down. Principal pay down is you're basically paying down the principal in your mortgage every year. You aren't paying it, your tenants are paying it for you. So that 34% return on your investment still hasn't even factored in your principal pay down. So like I said, it's hard to calculate. It differs year to year. Let's do a 10-year rate of return. So the stock market, after 10 years, if we're compounding at 9.8% per year, our initial $70,000 investment would have grown to $186,487.41 per year. That's tremendous if we keep our money in the market for 10 years and we don't touch it. How about in our home value? Let's compare that to real estate investment. So after 10 years, if we're compounding our real estate investment at our $300,000 real estate purchase, if we're compounding that at 3.9% annually, which is the annual average rate of return for real estate appreciation, our home will be worth $443,000. If we've been paying down our mortgage, and basically after 10 years, the principal balance on our mortgage will be $184,150. So equity is $258. That's the difference between the $443 and the $184. Our equity position is $258,000, almost $259,000 in equity. Plus, we've collected $120,000 in rents over those 10 years. So our net worth is the accumulation of our equity plus the amount of rents we've collected over those 10 years. So our net worth is $378,000, almost $379,000, as opposed to the $186. So as you can tell, if you compare and contrast real estate investing to that of the stock market, you're talking about $186,000 as opposed to $378,000, nearly a $200,000 difference. So what I'm getting at, you guys, is there's two very valuable tools that makes real estate investing one of the most superior investments in our country and has made more millionaires in this country than any other investment vehicle. And that is real estate appreciation compounded with leverage. The two combined create a powerful formula for you to really grow your net worth exponentially. The fact that real estate appreciates at an average rate of 3.9% per year is nothing too impressive. However, the fact that you've leveraged your acquisition with a mortgage, you're basically exponentially accelerating your net worth. That 3.9% per year is now multiplied. It's a multiplier effect. And your net worth is growing exponentially faster as a result of leveraged plus real estate appreciation plus positive cash flow. There's so many variables that when compounded all together, it creates a perfect storm and your net worth will grow exponentially to compare it to that of the stock market. So I hope I've opened your eyes as to why that your goal should always be real estate investing. If you're growing through the stock market, great. Continue to grow to the point at which you're then ready to reinvest your earnings from the stock market into the real estate market. Your goal should always be real estate. Real estate is the most powerful tool. We made more millionaires in this country through real estate than any other investment vehicle in this country. So I hope that's eye-opening, you guys. Thanks. Please like and subscribe. I appreciate you guys' support. Please keep subscribing, you guys. Please supporting the channel.